Um, Dr. Fishbein is a physician and scientist who has investigated and traded the financial markets for well over 25 years. His particular area of interest is mathematical systems with biological roots. For the past 15 years, his focus has been on hybrid artificial neural networks and genetic algorithm systems, both for end-of-day trading and more recently for day trading systems. He has lectured on these subjects, describing profitable systems for trading equities, exchange-traded funds, and index futures. I'm excited to learn more about it. Dr. Fishbein, I turn it over to you.
Our talk today is about using neural networks and genetic algorithms to trade cryptocurrencies. We're talking about money. If your interest is in the technical aspects of neural networks and genetic algorithms, well, that's another talk. I've been coming to TCF for a while. Here's a picture that Saul Liebes took at TCF1. I think that was 1976. That's me second from the left, and my good friend Don Liebes, who encouraged me to speak at my first TCF, is third from the left. Usually at this point in talks about financial matters, people show some long, complicated disclaimer. Yeah, I'm going to skip that and just say this one's simpler. Whenever people talk about financial topics, assume that what they're saying is not true, including what I'm saying today. Verify things yourself. This was one of my favorite ads that came in the mail. Wendy Kirkland, who has a number of systems, claimed that she had 41 times in 8 months had doubled her money. Well, this was too good to pass up. It did come with a money-back guarantee, so I sent away for it, $49. What it was a primer on basic technical analysis techniques. It included no stock selections, no option selections, and really wasn't at all what she had advertised. I did get my money back. This is a quote I heard years ago that I think is very important. It doesn't matter when people are speaking to you that they've worked for 4 different Wall Street brokers, that they've published a dozen books, that they speak at prestigious to prestigious organizations. What really matters is what kind of return are they earning with what kind of risk. I first got interested in neural networks doing a postdoctoral fellowship at the National Institutes of Health. My task was to come up with a way to identify specific regions of the brain on positron emission tomograms, which are tomograms that record, in this case, the level of glucose metabolism in various areas of the brain. I hit upon neural networks to help me out. This was in the infancy of neural networks. Had to write all the code yourself. It did prove moderately successful, and I was presenting my work to a large group of people. And I thought, just for a little interest, I'll throw in this very crude system I had done to predict S&P 500 prices. And when the talk ended, the first comment from my chairman was something like, "Yeah, Don, that was very interesting, but could you go back to that thing about the stocks?" And all of the questions following him were about the stock predictions, and nobody seemed at all interested in what I had spent the last 2.5 years doing. So anyway, I pursued this a little further. These are the objectives of the talk. First, that if you want to make money in investing, the stock market is the place to be. That you can time the stock market, that technical analysis, especially for the little guy, is the way to go, and that neural networks and genetic algorithms can provide a little boost. This is a graph from a book by Jeremy Siegel, an excellent book called Stocks for the Long Term. I think it's in its 4th edition. And here, I don't know where he's come up with all this data, but going back to 1800, He's calculated the gain on various investment instruments, and clearly stocks beat everything else, especially the dollar. Yeah. The tremendous gains he shows are in part due to the effects of compound interest, which even impressed Albert Einstein. And you can see from this graph that very small differences in the rate of return over the long term make tremendous differences in the total return. This is Jeremy Siegel. He makes this statement: you don't have to be a timer to do well in the market. And I'll have to agree, that's a true statement. If somebody came to me today, 18 years old, and said, what should I do with my money? A reasonable answer would be, put it in the stock market, put it in a ETF that tracks the broad market, and don't look at it. And over time, you would do well. Now, if you're my age, nearing retirement, that might not be such a good advice. And here's why. There's 7 occasions in the past 88 years, the market has dropped 50%. This is a graph from a friend of mine out here in Colorado, Don Rosenthal, a PhD economist. And what he's done on this graph is starting in any particular year, what your return might be. And you can see that there are many years you could start in which your return would be negative. The red are areas where the market has shown substantial drops. And you can see 69%, 81%, 54%. And the market has taken long periods of time to recover. I guess the counter to that argument would be, there have been many, many reasons for the market to go down over the years, and yet the market has just continued to plug higher. This was an article a couple months back in Bloomberg, I think it's Bloomberg Business Week. And I thought it was a funny article for them to publish, because Bloomberg made their money on these very expensive data terminals that help people time the market. And yet here it is. And the article is about the founder of Vanguard, who promoted the idea of low-cost mutual funds and ETFs where you could put your money and just let it grow. But this guy is, well, as they say, wrong on so many levels. These guys, Fama and French, won a Nobel Prize for the efficient market theory, which basically says the market at all times is efficiently priced, and its corollary, the random walk hypothesis, is that the next move the market makes is totally unpredictable. It's akin to a drunken person walking down the street, stumbling around. There's no telling which way they'll go. But even they acknowledged that the market does show momentum. And they called it an anomaly. I call it proof that their theory is probably not right. I guess if you're one of the flat earthers, you consider things like Newton's laws of gravity to be an anomaly. Einstein eloquently pointed out that it was easy to come up with that coming up with a counter example was a good way to disprove something. I've used this example for years. This is from the first stock market book I bought called Stock Market Logic, and this is the 4% swing system. The 4% swing system is very simple. It says if the market goes up 4%, you buy. If the market goes down 4%, you sell. It's going to catch the large trends. It's going to get whipsawed around when the market is not in any particular trend, but over the decades, and this was published back in the 60s or 70s, over the decades, it's beaten the S&P 500. And you can see down on the table on the bottom right that it's beaten that, not by much, but it has beaten the market. Here's another example. I like this guy a lot, Art Collins. He publishes fully disclosed, very simple technical systems. And he has gathered up some of his systems and reviewed their returns 10 years after he published them. And this is a very simple system he has. It's a day trading system. You take the first 5-minute bar after the market opens for, say, the S&P 500 futures. If the first bar is up, you buy, you sell at the close of the day. If the first bar is down, you sell short, close at the end of the day. And he's done quite well with this system. This is one of these systems that is a bit difficult to trade because it doesn't win much more than it loses, but when it wins, the wins tend to be larger. The profit factor, in other words, is greater than 1. But this is another great example that, yeah, you can beat the market. And he has dozens and dozens and dozens of these systems that all beat the market. And then, of course, there's, well, my system at nquant.com, which has not done spectacularly well, but has beaten the market on an annualized basis over the past 17 years that it's been published. And this system is available on a subscription basis at nquant.com. I love this sign. This is an actual real-life sign. It's at the north gate of the United States Air Force Academy in Colorado Springs. And it makes no sense at first, except for the fact that the explosive inspection station is at the north gate, where most other commercial traffic enters at the south gate. Anyway, when we look at the market, there's 2 basic ways to look at the market. There's fundamental analysis. This is the kind of analysis that Warren Buffett does, that Peter Lynch did, where you look at the fundamental characteristics of a company and decide, yes, that's a company that's undervalued and will increase in value in the future. And you buy it. That's great, but it takes a lot of work, a lot of research, a lot of expertise, and may use information that's not available to the common man. Technical analysis is mainly looking at the price action and then the volume action of a stock. The data is available to everyone, and that's what we're going to speak about in this talk. This is not to say that fundamental analysts are doing it wrong. They're not. And then, of course, there's people like this. I sat next to this fellow at a financial conference. And I don't think there's anything to this, but some people swear by it. And the important thing is this person has a lot of subscribers and makes over $1 million a year in subscription fees. This is a graph showing Buffett's returns over the S&P 500. And you can see that over the years, as people have paid more and more attention to him, the percentage by which he beats the market has gone down. This is a great book. It's out of print, but copies are available on eBay and Amazon. And the person, Mr. Wilkinson, made 2 important points in this book. One, the markets are not random, despite what people say. And they're not random because they're based on human behavior. It's the sum total of people buying and selling the market. And this is not random. Technical analysis can be broken down into 2 large categories. I mean, there's many other areas, but the 2 large categories are chart reading and mechanical trading. My preference is mechanical trading. When I look at charts like this, it just makes my brain hurt. I think chart reading and trend lines and resistance and support lines are very arbitrary, not repeatable, and most importantly, not very testable. It's just too much information for me. I prefer simpler systems. Yeah. Algorithmic trading is non-discretionary, uses in general indicators, which are functions of price and volume, follows rules, can be optimized, and most importantly, can be tested. The 2 independent variables are price and volume. I tend to focus on price, I think, as many people do, although there are a number of good indicators based on volume. I'm going to talk about one very simple indicator here called the moving average. Moving average is simply you sum up the last so many price points and that's your average. And then you move forward each day, you drop off one, add another price to the average calculation. The general principle is that you should be long when the price is greater than the moving average. Moving averages tend to lag the price. And that if you're looking at two moving averages, when the shorter period moving average is above the longer period moving average, that's an indication to be long. Here's the S&P 500 up to early last year. The blue line, the faster moving average, is a 50-day moving average. The red line is a 200-day moving average. These are very popular averages that are quoted on financial news services. And this point, about a quarter of the way from the left-hand side of the graph, where the blue line crosses the red line, 50-day moving average crosses the 200-day moving average, is referred to as a golden cross. And this is supposed to be a very bullish sign. And you can see the market tended to do pretty well following that. It was also doing well before that, but moving averages are lagging indicators. This is a very profound statement. I've sort of put this together from statements a couple different people have made, but the fact is that price action, which is what graphs look like, is similar across different instruments and across different time frames. And I'll show you two applications of this. One, the topic of this talk, Bitcoin, shows price action that's pretty similar to many stocks. Now, in terms of time interval, this is a great book, The Misbehavior of Markets, by the fractal guy, Mandelbrot. And I've read this book 2 or 3 times at different points over the past years. It's a very difficult book to understand, at least for me. But the take-home message is that the markets look about the same regardless of what the time frame is. And if I show you this graph and don't tell you what instrument it is or what time frame it is, you'd be hard-pressed to say what it is. Is it a 5-minute graph? Is it a 1-hour graph? Is it a weekly graph? Hard to say. Now, if I put the axis labels on, now it's easier to say. This is the S&P 500 from some time ago, and it's each bar is a 5-minute bar. Let's talk briefly now about genetic algorithms. Genetic algorithms, at least in this application, are simply a way to optimize more quickly than using conventional means. The characteristics of a trade, say the indicators we're using and the parameters for those indicators, are represented as genes. And then, very similar to biological evolution, the genes evolve by various methods. A gene can be copied directly. There can be crossover. In the second from the left picture, this is what happens with mother and father. The crossover shown on the right side is more like grandparents. And this is a graph indicating the progression of genetic evolution. Each each blue bar is indicating a possible gene combination that's being tested. And the third dimension of the graph is the error. And you can see early on, they're all over the place. The red bar represents the best gene combination up till then. And then as we get further along in the evolution, many of the gene combinations drop out, and we're left with the best one. Now, if you've done any computer science, at some point you've written a series of loops, for I equals 1 to n, for j equals 1 to n, for k equals 1 to n. The point is that when you get up to many of these parameters, the time it takes for that kind of optimization rises exponentially. With genetic algorithms, it's something less than exponential. Now I'm going to talk very briefly about neural networks. Neural networks are a way of taking a number of inputs and mapping it to an output. Now, frequently in technical analysis systems, people will propose 3 or 4 different tests, sum them up, and say if the sum is, say there's 4 items, if the sum is greater than 3, say, then that's a buy, less than 3, or less than 1, less than 2 is a sell. But maybe that linear combination with them equally weighted is not the best way to go. Maybe there's some more complex mathematical function that relates the inputs to the output. Neural networks are a way to uncover that and to do it quickly. Now, generally, with financial systems, we're talking about fairly simple neural networks, such as on the left, maybe one hidden layer. We're not talking about these deep neural networks that might be used, say, in computer vision. The reason is we don't have enough data to support these very complex neural networks. And when you get into very large neural networks, they actually have the ability, if you have a limited amount of data, you get to the point where they can memorize the data. And the neural network is not terribly good at giving you a prediction for data it hasn't seen before. One neural network architecture is the feed-forward backpropagation neural network, where the inputs are propagated forward, the error is propagated backward, and without going into any great detail, it's a way to optimize a neural network and to do it quickly. There are many, many, many neural network architectures, an infinite number. They have not all been as well characterized. One argument against neural networks is you're not really sure what's going on inside of them. You can look and see the weights of the connections, but it's still not clear always what's going on. This telephone pole is not in the United States, by the way. One problem, I mean, neural networks were introduced many years ago on Wall Street, and one issue was people did not appreciate that you could over-optimize neural networks. And so you can construct a neural network large enough so that it basically memorizes your inputs. The true value in neural networks is being able to generalize, to come up with an answer for data that it hasn't seen before. And so one thing you can do, if we just look at the very top line, is you can show the neural network some data and say, here, train on this data. And now here's some other data, the out of sample data in the green that you haven't seen before. How can you do with that? Well, that's good, but there's always the possibility that the neural network works and the out of sample data strictly by chance. So a way to kind of reduce that is called walk-forward testing. So what we do is we start out the very top line, we show it 4 weeks of data to train it, test on a 5th week, okay, it works. Then we incorporate the 5th week, we retrain the network, now using 5 weeks of data, and we show it week 6. So we're basically walking forward through the data. And the results of all of the green samples are our out of sample data. And you'll see when I show you my Bitcoin system in a little bit, you'll see the out of sample data summarized. All right. You can use neural networks and genetic algorithms together. And what we do is we iteratively apply a genetic algorithm, then the neural network, back and forth, back and forth, back and forth. And the idea is to arrive at the best combination of the parameters and the best way to combine them. And this is the system that I use. I use some commercial software right now called NeuroShell. It's good software, a little on the expensive side. There are many open source, freely available alternatives that I'm trying to switch over to, but I haven't done it here. So now we're going to look at a system for trading the Grayscale Bitcoin Trust. This is a complex financial instrument that roughly tracks the price of Bitcoin. Now, there are better instruments that have come out. BITO, symbol BITO, is one, but it's fairly recent, and it didn't have enough data for me to work with. So I used Grayscale Bitcoin, which has been out for a couple of years or more, but there are better instruments. We're going to use a very, very simple system called a moving average crossover system. And here we see this is very recent action in the S&P 500. It's been quite a week, by the way. I mean, Pi Day, the Ides of March, St. Patrick's Day, Purim, and this rather dramatic reversal. I think this is as of Thursday. So the green bar to the very right of the chart was Thursday. Friday was also an up day. And this is a very dramatic turn in the market. And we can see a problem, though, with moving averages. Just as it's heading up, the 50-day moving average has crossed below the 200-day moving average. Commentators refer to that as the death cross. Very dramatic name for a very mundane occurrence. And you can see the problem with that, that it's really lagging, that the 50-day is above the 200-day since the downturn started sometime at the end of last year. Maybe we can improve on that using some of our techniques that we've discussed. So in a moving trend system, these are the general parameters. Price is greater than the moving trend, and the shorter period moving trend greater than the longer period moving trend is a bullish signal, and vice versa. But a lot of it depends on what's the period of the moving trend. Well, genetic algorithms could help us decide what the best one is. And is there a better way? I mean, is there a better way to combine all this data than just these simple rules that I'm showing here? Let's skip that. I don't have to elaborate on my opinion of the CDC and Fauci's branch. So these are the inputs we're going to give to our system. The high, low, open, and close of the day, and two simple moving averages. We're going to start with default periods of 10 and 50, so it'll be a little faster moving than the 50 and 200 I showed, but we'll let the system decide what the best parameters are. And if we use 5-minute bars and re-optimize every hour, that's we're going to re-optimize 6 times in the course of a day, we get a system that looks something like this. And I realize it's difficult on this. The blue arrows are buy signals, the red down arrows are sell signals. And you can see in general, like say over on the right side, we have more buy signals and sell signals. Bitcoin has been heading up for the past couple of weeks. Now, if we do a system with 50 walk forwards, I'm only showing the last 20 on this chart for lack of space. But if we look at the very bottom line, the green is the out of sample trading. And this is over a period of about a month. If we would go back to the very top of the table. On an annualized basis, the system made 683%. Now, that's a very preliminary result. I'm not trading actual money in this. I'd like to test it for a somewhat longer period, but that looks promising. Now, what if we go to 1 hour bars? 5 minute bars, I have to say, you're not going to be able to trade that manually. That would really only work on an automated system unless you just have an incredible attention span and can sit in front of your computer all day long. But if we trade 1 hour bars, our return is quite a bit less. 85% annualized is still pretty decent. And that's an annualized return. There's only a month of trading. Going back to Mandelbrot's work, if it doesn't matter what period we're trading, if we look at a theoretical value, let's call it the maximum possible profit, and say if whatever the duration our bars are, 5 minute bars, 30 minute bars, 1 hour bars, 1 day bars, 1 week bars, the maximum potential profit is at the beginning of each bar, if we made the correct decision, long or short, what is our theoretical profit? And I think it's intuitive that our profit would be greater the shorter the bar was. And we've demonstrated that here. 1 hour bars versus 5 minute bars, quite a difference. This is what the trades look like. And now here's a chart summarizing what we had. With 1 hour bars, re-optimizing it, and you might say, why re-optimize every 7 days? And the reason is that we generate very, very, very few trades if we re-optimize daily. But anyway, the annualized return is, I think that should be 85.8%. With 5 minute bars, quite a bit higher, 8 or 9 times larger. And again, with 50 walk forwards. Now, to really be confident, we would need to use an additional testing mechanism called Monte Carlo testing. I think Monte Carlo testing came about in the Manhattan Project, but basically, when we don't have, the problem with any financial system is limited data. GBTC has been trading for 3 years, 250 data points a year, say, on a daily basis, 750 data points, not very much for comprehensive statistical testing. With Monte Carlo testing, we take the price series and we rearrange the prices, either the prices or the percent change in prices. I like percent change in prices. And we come up with a synthetic data series that looks like the original, but we can basically generate an unlimited number of these. And then we test those. And say if we test 1,000 systems as opposed to 50, we can get a better statistical feel as to whether the system is valid or not. So there's a lot of work left to be done on this, but it does look promising. And if you missed out on Bitcoin when it was trading for 10 cents or $1 or $100 or $1,000, there's still a way to extract some money from Bitcoin. I skipped over discussing just exactly what Bitcoin is, because I assumed anyone who would come to a talk with this title had some inkling as to what it was. There was an excellent talk 5, 6, 7 years ago at TCF by my good friend Don Liebes about the mechanics of Bitcoin. I think it's, to this day, the best explanation I've heard of it. I want to look into that if notes or anything are available. I'll just mention an infrequently maintained website, nquant.com. We do have a system I mentioned earlier called Delta, which has beat the S&P 500 consistently since 2005 when we started publishing the system. My first TCF talk on neural networks and stocks was in the year 2000. I missed a few years in there, but we used to originally put the signals out on the website for free, and then started charging a modest subscription. And Quantcom has all the information about subscribing. Before the fat lady sings, I just wanted to mention that if you have any inkling to help folks in Ukraine, I've looked into this. I looked at a number of organizations. There are naturally scammers out there. This group I've given to these people before. They have an excellent track record, and just something to consider. And that brings us to the end. I spoke rather rapidly. We got a late start due to technical problems, and be happy to take any questions. I cannot hear what's being said, so you'll have to type them into the chat box, and then I'll respond. If there are any, I'll be happy to take them. If not, we'll call it into it. Oh, I see one. Are the slides available to download? I will see about getting them to TCF to make them available. Yes. As in past years, I have to edit out some of the humorous ones because I'm not sure what the copyright provenance of them is, and don't want to get into trouble with anyone. Question from Ken, does your analysis consider Fibonacci rings? No. I've looked at Fibonacci a number of times, and all I can say is I may not just be smart enough to understand them. I don't really see how they work. I don't in any way mean to suggest they're not valid. Just that this is my method. This is what works for me. There are undoubtedly thousands of other methods that work, but this is what I concentrate on. Do you consider work like playing poker? In other words, you're a less skilled player. Good question. Good question. The answer is yes. And I think that I applaud the people who are buy and hold investors, because that's who's contributing to the returns of people who are timing the market. I don't think that I'm necessarily smarter than the next guy, but I have found something that works for me, and that's what I do. Does this imply you believe in Bitcoin over the long term? No, it does not imply that. I do, but it doesn't imply that, because I'm talking about trading 5 and 60-minute bars and average hold periods of a day or two. So I think in this kind of trading, I think the long term is irrelevant. Do professional traders with access to your orders affect your timing results? I doubt it. I honestly believe that if God himself, descended down to earth and told us what the market would do for the next week or month, 2 or 3% of people would listen to him. I think traders are very skeptical. They're all over the place. And this is incidentally, the most consistent question that's asked from year to year is, well, the two questions are, by making these results available, do you think you're going to affect your results? No, I don't. And why do you make these systems available? And I don't have a particularly good answer. I just enjoy sharing with other people. And every once in a while over the years, someone has said, hey, have you tried this? Would you like to work on this together? And that's another hope. And if anyone is interested in this, please get a hold of me. There's contact information on nquant.com. You can just send it to Don, D-O-N-N, at nquant.com, and I'll get it, or go to the website, and all of the email addresses ultimately come to me. So it's easy to get a hold of me. All right, let me catch up here. Do you consider work like playing poker? Actually, I do play poker, in a social setting every month or so with some guys in my neighborhood. I don't do very well. I'm not sure, Ken, I just see for annualized returns. I'm not sure what the rest of the question was. All right, let's see. You talked about returns, annual doubling. You've been doing this for 22 years. Yeah, no, I did not claim anywhere that I have doubled my money on an annual basis. Let me find the slide. We've beaten the S&P 500 by 5 or 6% each year on average. That increases return over the S&P, but nowhere near doubling. I'd be very skeptical of anyone who said that on a regular basis they could double your money. And you can just do the, just do the math. I mean, starting with any reasonable sum of money, you'd be able to finance the national debt. What are in this environment, what are your thoughts of adding more gold, hard assets? I like gold. I've always liked gold. Thoughts about NFT? I don't know much about NFTs other than people seem to be making an obscene amount of money with them. I can't believe that anything that there is an unlimited number of digital copies available of is ultimately going to hold its wealth, but who knows? Does it concern you there are no fundamentals in cryptocurrency? Well, there are fundamentals. I mean, with Bitcoin, there's a limited number of Bitcoins, 21 million, I think. But I understand what you're saying. It's not based on anything other than mathematical formulas. Again, I'm not concerned because I'm not concerned where Bitcoin is going to be in 10 years. I'm concerned where it's going to be on Tuesday. That really doesn't concern me. My question is, you have a chart that factors in commissions on the annual rate of return. No, that's a good point. No, it does not consider commissions, but with a lot of brokerages today, there are no commissions. But that would factor in. Also, GBTC has an annual fee of 2%, so that would factor into it. So this is an exploratory study. It is not to say, yeah, you should go out, tomorrow and start trading your money with it. How is the adoption of ESG scores influence your model? Not at all. I don't see how that would have any effect on Bitcoin prices. So, been a number of articles, by the way, that ESG scores need to be taken with a grain of salt, that many of them aren't really that accurate, and that companies that score highly it may not be some of the best actors around. All right, Larry, I think this is about when we're supposed to end. You can give me like a thumbs up if that's the case, because I can't hear you. Okay.
Yeah, so you cannot hear me?
Further questions, again, go to nquant.com, respond to any of the email addresses that are there, and I'll be happy to carry on a discussion with you. I appreciate everybody attending. I'm sorry for the technical difficulties in the beginning, and thanks, Joe. I appreciate your comment. We should talk soon. It's been a while. Anyway, we can all hear you fine. I can't hear a word, and I think it is the audio on my computer and not Zoom specifically. But anyway, all right. I'm going to sign off here. Thank you, Larry, for moderating. And
thank you, Joey.
I look forward, incidentally, to seeing everyone in person next year. I'm hoping that can be the case. Thank you.
Thank you.